Imagine losing your home to foreclosure and then getting socked with a big tax bill.
People who had their home foreclosed or sold as a short sale last year could get an unpleasant surprise from their mortgage company.
24-Hour News 8's Ann Schieber here to explain.
Well, here it is, the 1099-C. It looks just like your W-2 form, and it means pretty much the same thing. C stands for cancellation of debt, and in the eyes of the IRS, the bank's loss on your mortgage is considered income to you, and you have to pay income tax on it to the feds, the state, and maybe the city. Now, accountants are expecting a huge number of taxpayers to be hit with this form, which mortgage companies have to mail to you by January 31st. The tax will be due, of course, April 15th. Last year in Grand Rapids metro area, local realtors say 51% of all home sales were foreclosures, so those distressed homeowners should be getting the 1099-C. The 1099-C has been around for years, but taxpayers are unfamiliar with it because they usually don't have too many events that warrant it.
When you borrowed that money from the bank, you got it tax-free. $100,000, $150,000, $200,000, on the understanding that you would have to pay it back someday. That was a loan. When the bank forecloses and walks away from part of that debt, the IRS still keeps track and says, oh, you got $50,000 that you never paid tax on. That's income.
Now, there are 3 exceptions you can take to avoid the tax. Number 1, if you were in bankruptcy. Number 2, if you were technically insolvent, you add up all your assets and your liabilities, and if you can prove that you owe more than you own. And number 3 is the third one that you can add up if you have, if it probably apply in most cases if you're exempt from the tax if the cancellation of debt applies to your principal residence and you use the money to buy, build, or improve your home. This exemption, however, can be tricky because it may not work if you took out a home equity loan to pay for other things.
So if somebody took their accountant's advice and, instead of taking a $25,000 car loan or loan to pay for their kids' college education, if they took our good advice to say, no, do that as a home equity loan, tax-deductible interest, then that portion of that loan is not eligible for the exclusion.
And of course, you also have to have lived in the house for 2 of the last 5 years. Tax advisors say if you are not sure about any of this, this may be a very good time to find the cash and hire a professional because it can cost you big time if you make a mistake.